All right, let's chew on all this. Joining me now, we got Art Laffer, former Reagan economist. We got Steve Moore, host of More Money on WABC Radio. We have Douglas Holtz-Eakin, American Action Forum president, former CBO director. I begin with you, Arthur. Have I overstated the case? I mean, heck, if oil is plunging, gasoline's going to plunge. If gasoline and oil are going to plunge, then almost every other darn price in the index is going to plunge. And that's going to bring inflation down a whole lot more than anybody thought possible in a shorter period of time. Or how about this? Drill, baby, drill, and deregulation works. Looks like it's working to me. What say you?
I think it's working beautifully, Larry. I agree with you on that totally 100%. I don't quite agree with you on the jobs report. I was very impressed by the jobs report, to be honest. I mean, I would have thought employment may have come down a little bit. It should have. We have much less immigration of population. You sit there and say, you know, we had, 12 million under Biden, 13 million, whatever it is, illegal aliens coming in. There are now none at the border. In fact, a lot of people are going back. I would have expected employment to drop a little bit, but it didn't. It rose, and real wages are rising, as you say. That's all really good stuff. And when I look at this economy, we have a huge coming on January 1st. The tax bill, the BBB, is going to take effect with a lot of new tax cuts, a lot of policy changes that are really pro-growth. So I am expecting the next year to be very attractive, given the report we have now, and given the drop in oil, and given the thing we're going to change in the Fed. I mean, we're going to have a new Fed chairman who's going to be really good, long as his name's Kevin.
I said, thank you. I said the job report was decent. It was decent, okay? You're running.
Yeah, I think it's more than decent. I'm really excited by it.
All right, so it was decent, and I'm really excited about it. How's that, Holtz-Eakin? I go to you.
That's
75,000 private jobs averaging over the past 3 months. 88,000 private jobs over the last year. I'm using private jobs because federal jobs have come down almost 300,000. I mean, I'm fine with that number, and I especially like the wage portion for production workers, okay? Production workers, wages went up 0.3, but hours worked went up 0.2. So anyway, if you use the so-called wage income proxy, which not everyone uses, that gets you to about 5% year on year. And I'm saying, oh, Doug, tell me where I'm wrong here. You look at these oil trends. By the way, Brent crude is down below $60 a barrel, which is amazing. But West Texas is down around $55. That's unbelievable. It started the year at $80, okay? This is a year where the economy has been pretty deep. I don't think it's a collapse of demand in the economy. I think it's because drillers, even independents, the big seven sisters, they're taking advantage of deregulation in their industry, and they're drilling like all get. I mean, you're almost to 14 million barrels a day, Doug. That's an unbelievable number. 14 million barrels a day.
So let's start with the jobs report. So I can be at the other end of the Art Laffer scale. It's a solid report. It's not a great report.
You
we've
sound
got
like
64,000
jobs.
That's
what I said.
64,000 jobs. They're all in healthcare, and indeed, this has been the pattern since April, which is we're not getting private sector job growth in areas outside of healthcare services more generally. And I'd like to see broader-based jobs growth. I think that's sort of my concern number one. Concern number two is
construction, not bad. Not bad.
Concern number two is the wage growth is tapering on us. I take your point, Larry, but in this report, the growth in average hourly earnings was at an annual rate of 1.6%. I'd like to see the number stay a little higher. And so I think it's cooled down a bit in the job market. I'm concerned about that. The last number I'll point to is the so-called U6, the broader measure of underutilization of labor. That jumped from 8 to 8.7 between September and November. I don't like that trend at all. So I'm a little more concerned about the jobs report than Art is. I'm sure that's true. But I agree with you on the impact of the oil prices. A lot of people have been pointing to the lower end of the income distribution saying, look, there's no way we can continue household spending. Consumption is going to fall off. We're in trouble. I think historically, low energy prices have been one of the reasons that hasn't fallen off. Anytime we see a price spike, it's the lower income individuals whose spending gets hit. This is the reverse. It's supporting household spending, supporting the economy, and it's been a big benefit.
Well, I mean, it's really something to see $55 oil, and we're not in a crisis.
Yeah.
It's not like it's COVID or something of that sort, or it's not like
Right.
we're in a financial, meltdown of that sort. For example, I think it has a lot to do with policy. You know, Steve Moore, by the time we get finished here, it's going to be where we started, decent if not spectacular. I'm holding to that. So far, I got one nay from Laffer, and I got one yay from Doug Holtz-Eakin. Where do you come out, Steve Moore?
Right smack where I am on the screen, right between these two guys in terms of their assessment. I think Doug makes some good points, and so does, I'm a lover, not a fighter. But look, this is a really solid economy right now, no question about it. You know, one of the reports that I look at, which comes out about the same time as the jobs report, is what's called the JOLT report about how many job openings there are in America today, Larry. 7.8 million. Something like close to 7.8 million jobs. That's a lot of job openings. The problem is, and I think that Doug and Arthur would probably agree with me, is, you know, and by the way, those are some of those private sector jobs in some of those industries where, you know, we need more mechanics, we need more engineers, we need, you know, skilled workers in this country. And if you talk to employers, they're going to tell you they're having a hard time finding them. So I like the fact that we saw an increase in labor force participation. How about that one? Meaning more people getting into the workforce. And the other thing I would say, and you say this all the time, Larry, you didn't say it today, an oil reduction, price reduction is a tax cut. It's a tax cut for the American consumers, and it permeates throughout the economy. We're going to see a big boom in the beginning of 2026. And finally, I love the fact that we have about 300,000 fewer people working for Uncle Sam. That's called draining the swamp, Larry.
Yeah, about 270,000 year to date. It's a good number. That's Doge. Doge continues.
Yep.
Yeah, tax cuts are. I mean, oil reduction is a tax cut, but I think you see, Arthur, it goes back here. Look at, if you get, this is in a sense a bonus because the oil is a little more flexible and moves around faster, but now if you're going to have, I mean, I don't know, 1 or 2 percentage point drop in the consumer price index. Just think about that for a minute. Now, I've not done the math on this, but the math is very doable. But it's going to be somewhere between 1 and 2 percentage points because the move down happened only in 10, 11 months, okay, basically, and gasoline is now following suit. But it's the petroleum derivatives that matter, that affect everybody. So give it a few months to impact. That is I mean, I won't say it's a bonus because it's part of Mr. Trump's policies. But the reality is it's going to come on like gangbusters. I mean, everybody's worried about tariffs. Tariff this and tariff that. How about the lower oil price? Low oil price is swamping tariffs and every other bloody thing. And you want to talk about affordability? Hell, oil got up to $125 under Joe Biden. It's down to $55 now under Trump. What about those apples? I mean, that's an amazing thing. Go ahead, Art.
Completely agree.
Go ahead.
And
Tell me I'm not
tell
me I'm not enthusiastic enough.
Well, you're not enthusiastic enough, but you're okay. You're okay, Larry. I like Steve's a lot, by the way. But not only is it oil, but the economy has not been shrinking or anything. That's the thing that's really impressive to me. We're going to have control of the Fed very soon with a Kevin. And we're going to have economic growth. That economic growth is going to lead to lower inflationary expectations, in part because of oil, but also in part because of economic growth, the tax cuts that are coming on January 1st, all the other changes that are occurring that are all positive. And, you know, with all of that happening, I think next year is going to be a very good year. I agree with Steve. I think 26 is going to be a very good year for Trump and a very good year for the U.S. economy. And by the way, Douglas is completely correct. I mean, all the points he made are correct. This is not a perfect economy by far, but I think it's a really good. Well, I'm trying to be nice. I'm trying to be friendly with Douglas because I like him so much.
I got the back of your hand, but when Doug says it,
well, that's you, Larry. You know, you're an old friend. Douglas is.
It's terrific stuff. The fact is, though, let's go into next year.
Love it.
So one thing that Scott Bessent's been saying, has been reminding everybody, is that the withholding tables were not adjusted this past year, even though the tax cuts were retroactive. So you're going to get between 100 and 150 billion dollars of tax savings worth. And almost all that is going to middle income folks. Then you're going to get, when you get into next, that'll come in the winter quarter. Then you're going to get into the second quarter, April, tax payment quarter, and that's when the tax brackets, they don't adjust down, but they will stay down. And there is some indexing in that, if I'm not mistaken, Doug Holtz-Eakin. So they're going to get they're going to get a second bonus. All the business stuff is kicked in already. You've had a capital spending boom, or at least the makings of a capital spending boom, machinery and equipment. I can't vouch for factories, but I think that's going to be the next step. We had the CEO of Ford Motor Company, after losing $20 billion on electric cars, he's finally thrown in the towel, and he's going to build some factories for some good hybrids. Good for him. You know, better to be late than not do it at all. But I'm just saying, I don't know, some of that money, Trump talks about, what, $15 trillion of investment capital coming in from overseas. Sometimes that number gets as high as 20. On the website, it's, I think, 19. If he gets a third of it, it's a boom, right? I mean, that's the thing. Whatever, you know, he likes to embellish, we know that. But even if he gets a third of it, it's a hell of a thing.
Well, Larry, listen, I want to say two things about where we are. Number one, there are two reports that are really important coming forward. We're going to get a CPI report on Thursday. We can test out your theory about the low oil prices passing through, just see how big that impact is. I'm looking forward to that. And I'm really anxious to see the third quarter GDP report. I mean, the first half investment spending was really strong. 15% real on equipment, 10% on software. Structures were weak. I'd like to see what it looks like in the third quarter. And if the labor market's essentially flat and you still got 3.5% real growth, that's a productivity boom that people aren't talking enough about. That's an enormously large number. So I'm looking forward to seeing how that plays out.
You know, Kevin Hassett talks about that all the time, including today, Steve Moore. It's really a very important point. We don't necessarily need, at the moment, a massive increase in labor force participation or in the number of people filling out jobs. Because if GDP, Atlanta Fed is, what, 3.5% for Q3. Yeah. Now, we may have pinched down a little because of the shutdown in Q4, but my suspicion is the underlying growth is 3% plus. So that leaves you with a big productivity number, Steve Moore. Yep. And that's another counter-inflationary development. I mean, high productivity is to die for, and all these Federal Reserve models that are going to get cleaned out when Powell goes, they don't acknowledge it. They never acknowledge it. The last guy in official Washington that acknowledged productivity and supply side effects was Doug Holtz-Eakin when he was running the Congressional Budget Office. And he was the best. He is the best one we ever saw. But Steve Moore, what about the productivity story? What about the AI story?
Yeah, look, technology, robotics, AI are going to dramatically reduce costs. I don't know how fast that's going to happen. If Doug is right, it's already starting to happen, but it is definitely coming in a big, big way. And, you know, what is economic growth? It's productivity plus the workers, you know, workers working and making workers more productive. It's another reason to be super bullish, and it's a reason why Trump is right on interest rates. Interest rates are going to come down, and that's another tax cut, by the way, Larry.
Well, rates will come down naturally. They won't be forced down. They'll come down naturally because of the lower inflation and the lower expected inflation. I mean, actually, you know, for all the talk about, well, these new Fed people listen to Mr. Trump too much, the reality is through this whole period, if you use the Treasury break-evens, right, the CPI break-evens, the so-called tips and so forth, they've actually fallen this year. All right, inflation expectations, if you use the 2-year tips, they've fallen 17 basis points. If you go out and use the 10-year tips, they've fallen by 8 basis points. But, you know, they haven't gone up by 10, 20, 30, 40 basis points.
Larry, by the way, over the last 6 months, commodity prices have actually fallen.
Yes.
And commodity prices
Yes.
are one of the best lead indicators of where inflation's headed.
Yeah, lumber's dropped a lot off,
Yeah.
too. Copper's been pretty flat. Arthur, you've been very quiet in the last 10 minutes. I'm waiting for you to say something.
I'm just relishing the deliciousness of the information I'm receiving. I think all of you agree with me. It's going to be a great year next year.
What about the stock market, Arthur? You used to write about the stock market. So the S&P 500, since the bottom, which was in early April, it's up about 35%. As the Wall Street Journal reported yesterday, the Dow Jones Transport Index, now that's old Dow theory, but the transports are backing up the broader indexes. That thing is up 38%. And hang on, one more, Arthur. The small cap Russell 2000 is up 44%. Now, I'm giving you these numbers to show you how much homework I do, but they're also showing you how important. It's a very varied market. It's not just 7 companies. The stock market is telling you something about next year.
I'm resting my case. I couldn't be more optimistic than I am. The stock market tells us what will be, not what has been. And when you're looking at these markets, given that where we are today and where we're going to be in the future, you just couldn't be more optimistic than now with this jobs report, where I think your inflation report's going to be on Thursday, Douglas. I think all of these things combined, and when the BBB comes into full effect on January 1st, it's going to be very pro-growth. When the new Fed chairman comes in, it's going to be very pro-growth. And, what more? I'm giddy already, and I'm 85. I don't like the 10-year yield because it's 85, but, I like the 2-year. I'm still fine with that and green bananas. But
by the way,
other
Arthur,
than that,
you should refer to it as the one big, beautiful bill, for heaven's sakes. It took me 9 months to get that into the lexicon. All right, I'm just going to assume silence is golden.
Okay.
Art Laffer, thank you very much. Steve Moore, Douglas Holtz-Eakin, to all of you, appreciate it very much.